This is a good one. This is a good one. So I have a few clients, not many, that give away a very large portion of their income. Used to, you could give away 50% of your income and deduct it on your Schedule A. They've actually raised that now to 60% of your income. One of the ways to kind of get around this is because now the standard deduction has been raised so much that it's going to cause people to do one of two things. If you are over age 70 and a half and you are taking required minimum distributions from an IRA, you can take that money and you can make a qualified distribution straight to a charity from your IRA. Bypasses your tax return altogether, bypasses this limit, bypasses everything. Basically, it's tax-free. You're sending money to a company or to a charity. It doesn't show up on your tax return as taxable income. You can do up to $100,000 a year by doing that. The second thing people are going to start to do is they're going to start to bunch charitable contributions. So in a normal world, I give $10,000 a year to my church. What it's going to cause me to do, because if I give $10,000, I'm not going to itemize my itemized deductions because it's going to be below the limit. But if I give $40,000 all at once, I'm going to be able to itemize that deduction and take a benefit for that charitable gift. So what people are going to do is they're going to start to bunch all of their charitable gifts in 1 year, skip the next couple years, and then 3 years down the road, you do it again. You bunch all your charitable deductions into 1 year, being able to take advantage of this. This one is interesting. So miscellaneous itemized deductions no longer exists. One of the things that used to be able to be deducted is management fees paid to an investment advisor. It was a miscellaneous itemized deduction. That has been repealed. That's gone. You could deduct your union dues, any unreimbursed employee expenses, tax prep fees, post office box, safety deposit box, all that's gone. So if you work for someone and you get a W-2 and you are spending money that you're not getting reimbursed for from your employer, this is where you used to deduct it at. Well, that's no longer there. So if you get a W-2 and they expect you to shell out cash to do your job, you need to have a conversation because you're no longer getting a benefit for that. This is really heavy in the trucking industry, where a truck driver is over-the-road truck driver and he is getting a per diem rate that the IRS publishes to be able to take meals and lodging while he's out on the road. Some of these deductions, I mean, for somebody who's on the road 6-7 days a week, these deductions were huge. They're not there anymore. So people have some planning that they have to do on how to circumvent some of these changes that are in there, because some people are going to be affected a lot. So I talked about most people are going to be beneficial from these changes. A truck driver right there is going to be one of the people who's not. For higher income taxpayers who were itemizing deductions, your deductions were actually limited based on your income. That's been repealed also, which is a good thing for a little bit of a higher income taxpayer, which are most of the time the people who are itemizing their deductions anyway, are going to be able to get the full benefit of their itemized deductions instead of getting a haircut from it. And this one, hopefully this one doesn't affect anybody, but being in Kokomo and seems to be an attraction of tornadoes in the recent past, casualty losses. And this is going to be kind of a dicey one, because casualty losses, something happens to your house and the insurance doesn't cover it all. And so you have to put out $30,000 to get your house back to where it was. There used to be a provision where you could deduct that on your tax return. Now, the only way for you to be able to deduct that on your tax return is the area that you're in has to be declared a federal disaster area, which I know here in Kokomo, that was a pretty interesting point, because I believe with one tornado it was and one tornado it wasn't And this is a federal government thing here. So if it's declared a federal disaster area, you'll be able to take a benefit from this. But for whatever reason, I don't know the criteria as to why they do and why they don't declare something a federal disaster area, but this could have, I mean, there again, it's an odd situation that you hope you never get yourself into because it means something drastic has happened to your life, which I pray that doesn't ever happen, but it does happen. And this would be an interesting one because of just, for some reason, I mean, you've got a external 2-car garage and it burns down. And for whatever reason, it's not properly insured or something. Your tax return is going to kind of hang you out to dry on that one. So this is the itemized deduction form, which looks pretty much just like it did. There's a couple little things where they've taken out the miscellaneous itemized deductions. They've modified it to suit the needs of what they have changed. So statistically, people who have a CPA prepare the return statistically have a higher rate of itemized deductions. So our firm files a lot of itemized deductions. We've already been through our system. We're still gonna file a lot of itemized deductions, even with the standard deduction being $24,000. So we're still gonna file this form a lot for our clientele.